Hello everyone. Why so serious? Warren Buffett Top 10 Principles How to Invest for Beginners. Warren Buffett is one of the most successful investors of our time. Who hasn't heard of Warren Buffett, the Oracle of Omaha, one of the world's richest people, consistently ranking high on Forbes' list of billionaires? Buffett follows several important principles and an investment philosophy that is widely followed around the globe. So just what are the secrets to his success? Of course, I personally think his investment strategies are a bit boring, but for the long term it's effective and you can probably sleep well knowing your stock should be relatively safe. So here are the 10 best Warren Buffett investing principles. Number 1. Know what you're investing in. One of the easiest ways to make a mistake that is avoidable is getting involved in investments that are overly complex. If you cannot get a reasonable understanding of how a company makes money and the main drivers that impact its industry within 10 minutes, you can move on to the next idea. Many of us have spent our entire life working in no more than a handful of different industries. We probably have a reasonable strong grasp on how these particular markets work and who the best companies are in the space. So buy the stock that you understand. For example, if you work in healthcare business such as a nurse or a doctor, select a healthcare related stocks. That'll be easy. As quoted by Warren Buffett, never invest in a business you cannot understand. Number 2. Never compromise on business quality. You might be surprised to learn that the name Berkshire Hathaway comes from one of Buffett's worst investments. Berkshire was in the textile manufacturing industry and Buffett was enticed to buy the business because the price looked cheap. He believed that if you bought a stock at a sufficiently low price, there will usually be some unexpected good news that gives you a chance to unload the position at a decent profit, even if the long-term performance of the business remains terrible. With more years of experience under his belt, Warren Buffett changed his stance on cigar-butt investing. He said that unless you're a liquidator, that kind of approach to buying business is foolish. The original bargain price probably would not turn out to be such a steal after all. In a difficult business, no sooner is one problem solved than another surfaces. These types of company also usually earn low returns, further eroding the initial investment's value. Warren Buffett's investment philosophy has evolved over the 50 years to focus almost exclusively on buying high-quality companies with promising long-term opportunities for continued growth. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price, quoted by Mr. Warren Buffett. Number 3. When you buy a stock, plan to hold it forever. Once a high-quality business has been purchased at a reasonable price, how long should it be held? Warren Buffett clearly embraces a buy and hold mentality. He has held some of his positions for a number of decades. Why? For one thing, it's hard to find excellent business that continue to have a bright long-term future. Furthermore, quality business earn high returns and increase in value over time. Fundamentals can take years to impact a stock's price, and only patient investors are rewarded. One of my favorite Warren Buffett quote is, "The stock market is designed to transfer money from the impatient to the patient investors." And he's damn right. Number 4. Diversification can be dangerous. Simply put, Warren Buffett invests with conviction behind his best ideas and realizes that the market rarely offers up great companies at reasonable price. Excessive diversification also means that a portfolio is likely invested in a number of mediocre businesses, diluting the impact from its high-quality holdings. Diversification is a protection against ignorance. It makes very little sense for those who know what they are doing. Quote by Warren Buffett. How many stocks do you own? If the answer is more than 60, you might seriously consider slimming down your portfolio to focus on your highest quality holdings. Number 5. Most news is noise, not news. There is no shortage of financial news each day, especially during this technological era. Most of the news headlines and conversations on TV are there to generate buzz and trigger our emotions to do something, anything. Because there's so much chatter about markets, the economy, the interest rates, price behavior of stocks, etc., some investors believe it is important to listen to pundits and worse yet, important to consider acting upon their comments. Quoted by Warren Buffett. The companies that Buffett focused on investing in have thus far withstood the test of time. Many have been in business for more than 100 years and faced virtually every unexpected challenge imaginable. Imagine how many pieces of gloom and doom news originated over their corporate lives, However, they are still standing up till now. As investors, we need to ask ourselves if a news item truly impacts our company's long-term earnings power. If the answer is no, we should probably do the opposite of whatever the market is doing. The stock market is an unpredictable, dynamic force. We need to be very selective with the news we choose to listen to, much less act on. In my opinion, this is one of the most important pieces of investment advice. Number 6. Know the difference between price and value. Stock prices are always going up and down. They are volatile beings, and you should know that stock prices are inherently more volatile than underlying business fundamentals in most cases. In other words, there can be periods of time in market where stock prices have zero correlation with the longer-term outlook for a company. Many bargains were available during the financial crisis because investors were too quick to sell off all companies, regardless of their business quality and long-term earnings potentials. In other words, a company's stock price was temporarily separated from its underlying business value. As famously quoted by Warren Buffett, price is what you pay and value is what you get. Investors need to distinguish between price and value, concentrating their efforts on high-quality companies trading at the most reasonable prices today. Number 7. The best moves are usually boring. Investing in the stock market is not a path to get rich quickly. If anything, he believes the stock market is best meant to moderately grow our existing capital over long periods of time. After all, the goal is to find quality business that will compound in value over the course of many years. If we get this right, our portfolio return will take care of itself. Many companies that boast long and successful corporate lives provide basic products and services, snacks, beverages, toothpaste, medicine, convenience stores, etc. There's no need to try and be a hero or impress anyone with our investments. Boring can be beautiful. Number 8. Low-cost index funds are sensible for most investors. Do you know that most investors fail to beat the market and often by a wide margin? We hurt our performance in many different ways, trying to time the market, taking excessive risk, trading on emotions, venturing outside our circle of competence, and more. Despite his status as arguably the most prolific stock picker of all time, Warren Buffett advocates for passive index funds in his 2013 shareholder letter. My advice to the trustee couldn't be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I suggest Vanguard's. I believe the trust long-term effect from this policy will be superior to those attained by most investors, whether pension funds, institutions, or individuals who employ high-fee managers. Quoted directly from Warren Buffett. Number 9. Only listen to those you know and trust. Throughout these shareholder letters and occasional interviews, Warren Buffett emphasizes the importance of only investing in trustworthy, competent management teams. Simply put, Warren Buffett is very careful when it comes to selecting his business partners and managers. Their actions can make or break an investment for many years to come. While we lack the resources to really evaluate the character and skill of a public company's CEO for investing purposes, we can centrally control who we listen to when it comes to selecting our investments and managing our portfolios. The financial world is filled with many characters, good and bad. Unfortunately, a number of folks realize they can prey on investors' unrealistic expectations and feelings of fear and greed to make a quick buck. Many finance gurus and talking heads are in the business of getting eyeballs to sell more advertisements, making sensationalist claims to gain new subscribers, or convincing investors to place trades in order to gain a commission. We have long felt that the only value of stock forecasters is to make fortune tellers look good, quoted by Warren Buffett. He urges investors to stay focused on the facts, recognize the amount of randomness involved in investing, set realistic expectations, and stay the course. Number 10, and it's my favorite one. Cash is king. If Warren Buffett has cash in his pocket, it might just stay there. While he is a strong proponent of taking advantage of opportunities in the stock market, if there's not an opportunity that currently fits into his criteria, he's also happy to hold his cash. Liquid cash in your pocket gives you the opportunity to take advantage of strong opportunities in the stock market as they arise, rather than settling for stock that simply won't produce the returns you're looking for. As such, be highly selective in the investments you make. If you can't find a stock that fits into your investing strategy, hold your cash. More opportunities will arise soon. There you go. These are the top 10 principles of investment by Warren Buffett. So, Warren Buffett follows a simple approach rooted in common sense. We often make investing harder than it needs to be. By embracing some of Warren Buffett's investment advice, which is focusing on the longer term, sticking to blue chip dividend stocks, remaining within our circle of competence, we can better manage our portfolios to reduce the number of costly errors we make and continuously move closer to achieve our goal. Thank you. And why so serious?